And that's been the big question here today. So, when we look at demand, demand's a little trickier than supply. Supply, you can sit down, look at a whole bunch of data, and do some reasonably good estimates of what supply is going to look like. Demand's different. Demand has an awful lot of exogenous effects. It is a new industry in many regions, and in those industries, you have to predict, as best you can, what demand might be. So, I have heard assessments on how to do this from pick a number out of thin air, assume a growth rate, look at historical growth rates and project them into the future, to random other approaches. What we decided to do, right or wrong, was look at ROI-based demand, meaning return on investment. We looked at each region. We looked at particular regions like Germany and Japan where there is a historical basis for growth rates based upon project ROIs. It's not a trivial thing to deduce, but you can come up with average return on investments for projects, and you can look at relatively mature markets, Germany, Japan, in the first half of this decade, and come up with growth rates correlated to returns on project investments. That's what we tried to do. When you look at that, these are all the regions we looked at. These are the growth rates, and it's not important what all these numbers are at the bottom. What is important, though, is when you start looking at ROIs, and you start correlating this to growth rates. When you look at the large markets now, Germany and Spain, 2008, 2009 are operative here. Why was Spain such a high growth market? Because the average ROI, as best we can calculate it, was significantly higher than Germany. Germany is somewhat unique, in my opinion, for the simple reason that the incentive structure has been able to drive an ROI, average ROI for, say, a 1 megawatt installed system in roughly an 8% range for a few years now. It's interesting because that allows you to effectively control the growth rate as best a growth rate can be controlled, roughly 30, 35%. All that said, it looks like Germany maintains that track, both on ground and roof mount, and Spain bounces around a bit. Bounces around based upon inputs, what you think feed-in tariffs will be. All that said, we then look at next growth markets, Italy and South Korea. And when you look at the generosity of some of the feed-in tariffs that we have, you see very high ROIs. What you have to overcome in a lot of these new markets are institutional impediments, things like bureaucracy, things like difficulty in permitting. There's an awful lot of that takes 1 to 2 years before you can iron out at least that inefficient part of the value chain and begin to drive growth in a market. Same thing with these new growth markets like France and Greece. And conspicuously below that are the near-term laggards, which is Japan and the US, for a lot of different reasons. All this said, when you start looking at all of this and you start building out growth rates, we'll be doing some significant adjustment on these numbers for Spain in the not-too-distant future for obvious reasons, which are not in these numbers that were published a couple of months ago. All that said, we start looking at a demand scenario. With a base case of about 4.3 gigawatts in 2008, 6 in 2009, and a bit over 9 in 2010. Gives you a base case growth of about 50% over the next few years. That's significant, significant growth. We look at an upside case because my bet is that if we end up with ASPs dropping rather substantially, what you'll have is an upside case and not a downside case. With an upside case, it could be as high as 6.2, not much in 2009 because we're relatively close, or 11.1 in 2010. When you take a look at this demand scenario and you marry it with our supply forecast, you put in supply base case, downside, our upside scenario, and now demand, both upside and base case. And what does it tell us? Supply should exceed demand sometime in 2009, probably the second half of 2009 is my guess. Now, it could be persistent for a while, or it could simply flirt with oversupply as ASPs come down and demand actually climbs higher than what I've forecasted. That would be an upside scenario, probably a bit more than what we have presently. If everything is perfect, you can take a look at our upside demand scenario and our downside supply scenario, which in my opinion is unrealistic, and it gives you relatively good balance over the next several years. That won't happen. What did we just do? Ah, there we go. Sorry about that. So, what does this tell me overall? This is hardly definitive. This is not a definitive assessment of supply versus demand and what we think is going to happen in the industry. This is probabilistic. This is our best estimate, but what it tells us is not that we are absolutely going to have an oversupply, although I do believe we will. It's that I think there is a much higher probability that we will than we won't. And when you start doing sensitivity analyses around all of these numbers, that becomes fairly well evident. So that said, that's the dynamic that largely drives the industry over the short term. Next, we look at economics by technology, which is levelized cost of electricity. What that provides you with, quite clearly, is the industry's competitiveness. The industry's competitiveness with respect to technology, companies, and overall. So when you consider this type of an analysis, you have to look at the overall value chain, and you have to look at it in three places. You have to look at it at the module, the system, and a levelized cost of electricity. And what a lot of investors miss is that this industry is about selling energy. It's not about selling modules, and it's not really about selling systems either. So when you look at these different areas, the issues you start to run into is largely at the system calculation level. There's an enormous amount of variance error in the data at the system level. So bear that in mind when you start to go through numbers. I'm sure there'll be an awful lot of debate on what people think the right numbers are. But this is our best estimate on how we calculate and what we come up with for a levelized cost of electricity by technology. What's important about this is a company's cost structure at certain points in this value chain have enormous implications on the business model and how viable that company and that company's technology and product is going to be going through a shakeout phase and over the long term. So if we look at the module, and the first thing I want to point out here is we look at three different variations of crystalline silicon modules. We look at average crystalline silicon, which is most of the industry. We look at what I call this high-low. High conversion efficiency, higher than average, low cost. This could be something like a SunTech model in the future. And then we look at a third variant, which is high conversion efficiency. It's a SunPower model. Then we look at thin films. Amorphous silicon and copper, indium, gallium, selenium, they are not in production. These are our estimates based upon spreadsheets and data input, not based upon empirical data, because there is none. And then there's cadmium telluride. Cadmium telluride is a disruptive technology at the module level. When you look at this from a percentage comparison, baseline crystalline silicon at 100% normalized, the other crystalline silicon approaches below that, the thin film approaches, including cadmium telluride, and what you have is cadmium telluride is a disruptive technology with a 60% cost per watt advantage at the module level over average crystalline silicon. That's a sustainable advantage over time. It may not remain 60%, but it could certainly remain 50%. If this were the end of the analysis, and a lot of the investment community seems to stop here, you would take everything you own, mortgage your house for the third time, and buy as much stock in cadmium telluride companies as you possibly could. If you did that, you'd probably have some issues down the road. The other thing you'd do is short everything else. That's not the end of the analysis. You now have to look at system and levelized cost of electricity. And when you do so, it's a very different picture.